Good afternoon. It's always a pleasure to speak at the Empire Club. The market outlook in 2016 presents significant challenges and opportunities that we have not seen for 40 years. Since I began working on creating our first bullion fund in 1998, I have generally restricted my commentary to using precious metals for strategic portfolio allocation. Everyone agrees that investment portfolios should be diversified. Since gold is the most non-correlated asset to traditional financial assets, it provides important portfolio diversification. A strategic allocation of at least 10% reduces portfolio risk and improves returns over the long term. This year, I'd like to talk about a tactical opportunity, a market disparity that exists because of an artificial low in the price of gold and an unsustainable high in financial assets. Everybody understands the concept of buy low, sell high, but the opportunity for 2016 is going to be sell high and buy low. Although the Canadian market has been somewhat muted, many Canadians have invested in U.S. equities since 2009. And since 2011, they have also received a 32% bonus because the Canadian dollar declined against the U.S. dollar. However, this rise in equities is largely the result of the U.S. Federal Reserve increasing its balance sheet. The monetary policy of low interest rates resulted in trillions of dollars in stock buybacks and mergers using low-cost borrowed money. These monetary policies on part of the world's central banks have caused bubbles in stocks, bonds, real estate, and exotic cars. These are not likely to continue in 2016, and the risk of a major correction looms. In 2000, we had the tech sell-off that no one expected. 8 years later, we had the subprime sell-off that no one expected. In 2016, another 8 years along, we're likely to have an equity sell-off as global economies contract and political tensions increase. It should be clear that the global economy is contracting and there are numerous vulnerabilities. But there are several methodologies that summarize the current market fundamentals without getting into the details and provide an excellent predictor of future trends. These are the Buffett Indicator, the Shiller P ratio, and the Tobin Q ratio. The Buffett Indicator uses the total market capitalization of U.S. equities divided by US GDP. The only other times the Buffett ratio exceeded 100 was prior to the tech crash in 2000 and a credit bubble in 2008. The Shiller P is a popular indicator of stock valuations. The 134-year average is 16.7, whereas the current ratio is 25.9, or 55% overvalued. The ratio has only been this high on 3 occasions: 1929, 1999, and 2007. Each time it happened, stocks dropped by over 50% and didn't recover for years. The Tobin Q ratio, which measures market value versus replacement cost, is considered one of the better long-term indicators of a pending market decline. The current Tobin Q ratio exceeds the 70-year average of 0.7 by 58%. This ratio only rose above this average in 2000 and 2008. This time, however, the correction could be much worse than either 2000 or 2008. Not only do we have a significant overvaluation, but this historically high margin debt will accelerate the decline due to margin calls. These conditions provide investors with the opportunity to sell high and take a profit. Now, the buy low opportunity exists because gold has been in a cyclical correction for 3 years and seems to have formed a bottom. Gold's strong fundamentals point to a bright future. And of course, gold has always protected portfolios during market declines, as you can see from the accompanying chart here. The future for gold pricing is not complete without understanding the implications that China will have. China has been increasing its gold reserves and has made a number of strategic moves that threaten the US dollar's currency reserve status. China has signed 28 currency swap agreements wherein the US dollar is no longer used to settle trade imbalances. The Asian Infrastructure Bank has been formed as an IMF alternative to provide loans to BRIC countries. The yuan currency exchange hub has been created in Canada with the ICBC Bank. China has developed an alternative to the SWIFT system of international currency transfers, and Russia is also developing its own version. The Shanghai Gold Fixed, which is scheduled to be introduced in the spring of 2006, has a good chance of eliminating the short selling that takes place on the COMEX, because the Shanghai Gold Fix is going to be based on physical only, without any paper market dilution. If traders try to drive the price of gold down on the COMEX through shorting, arbitrage traders in Shanghai will quickly counter the move. In 2015, the results of these changes has already started to show, as 71% of the US Treasuries were purchased by the Federal Reserve itself with newly issued currency as demand for US dollars has decreased. Finally, to reinforce the buy low opportunity, a comparison to the cyclical gold correction from 1974 to 1976 and a subsequent price rise serves as a good example. At that time, after a 445% rise from 1971, gold declined 45%. Gold sentiment was at a record low, and the media was full of negative gold commentary, just as it is today. On March 26, 1976, the New York Times stated, "For the moment at least, the gold party seems to be over." It also quoted a Citibank letter that declared gold was an inflation hedge in the early 1970s, but money is now a gold price hedge. It suggested that the rout was due to the victorious dollar. The victorious dollar has lost 80% of its purchasing power against gold since that day in 1976. After 2 years of declines, many investors sold their gold holdings and vowed never to invest in gold again. However, in the fall of 1976, gold began its ascent. that saw a 750% rise, peaking at $850 an ounce just 3 years and 4 months later. After a 3-year correction, the same opportunity to buy low exists today, just as it did in 1976. Of course, conditions were different then. We didn't have a stock market that was in a bubble, and the total U.S. debt at the time was $800 billion. That's less than the annual deficits. I'm often asked, how high will the price of gold go? And I still think it will hit $10,000 an ounce, as I've described in my book. The conditions detailed in my book are very much still in place, and many of the vulnerabilities that I discussed have actually increased. Now, the other indicator is that there's been a lockstep relationship between gold and the US dollar, as this chart suggests. If the US debt continues to increase at the same rate that it has in the last 10 years, it will actually reach 26 trillion. This is a good indicator that a gold price of at least 2,500 is likely in the near future. Thank you.